Ever see silver prices skyrocket, only to fall off a cliff? You might think demand just evaporated. But that's not the real story. Silver didn't crash because people stopped wanting it. It crashed because the rules of the game suddenly changed. Let's break it down. The main trigger was something called a margin hike, announced by exchanges like COMEX. Think of margin as a down payment for trading. When they hike the margin, every trader who holds a silver contract suddenly needs to put up more cash right away just to keep their position open. Imagine waking up to a massive, unexpected bill. This forces a wave of forced liquidation. Traders who can't come up with the extra cash have no choice but to sell their contracts, and they have to do it fast. Now, why did this turn into a complete freefall? It's all about liquidity and a domino effect. In certain market conditions, there aren't many buyers ready to absorb all that sudden selling pressure. This is called thin liquidity. With so many sellers and so few buyers, even a small number of forced sales can push the price down significantly. This drop then triggers automated stop-loss orders from other traders, which means even more selling floods the market. More selling leads to lower prices, which then triggers more margin calls for other traders who were previously safe. It becomes a vicious, self-feeding downward spiral. One domino falls, and it takes the whole chain with it. It's crucial to understand the difference between the paper market and the physical market. The price you see crashing on the charts is the paper price, driven by futures contracts, algorithms, and high-leverage trading. On the other side, you have the physical market, the actual silver bars and coins. While the paper price was in a freefall, demand for physical silver often remained strong, and sometimes even increased as people rushed to buy the dip. The paper price simply doesn't reflect the full reality of physical supply and demand. So what's the key takeaway here? A rules change, like a margin hike, is designed to flush out the weak hands, the highly leveraged traders who can't handle the volatility. This creates a huge opportunity for the strong hands, cash buyers and long-term investors who can step in and accumulate silver at a much lower price. They aren't scared by the paper price fluctuations because they understand the underlying value. Markets move on rules just as much as they move on fundamentals. Understanding these mechanics is key to navigating the world of investing. If you want more deep dives like this to help you see what's really happening behind the charts, make sure you subscribe to the channel. Thanks for watching.